Hello, I'm Brian Beaulieu from ITR Economics. Thank you for joining us for this edition of FedWatch. Today is October 6, 2023. And there's some interesting things going on. Three main things that I want to hit upon with you today. One is ADP jobs report is out. It doesn't always align with the Fed's report, but there is a clear trend using the ADP data, and that is the rate of hiring is slowing down. According to ADP, only 89,000 jobs were added in September. And that's below what you'd expect for a healthy economy. And the reason that's important is because it could give the Fed one of the data points they're looking for in terms of refraining from raising interest rates again. If you look underneath some of that headline data, it's pretty clear that the reason there was so little job growth is because there were 83,000 jobs cut last month. Any cutting of jobs is interesting. And what my takeaway was, it was from large firms, not small firms. That's not surprising. But it was noteworthy that it was across sectors. It was in manufacturing, it was in professional services, it was in trade, utilities, transportation. And this, I think, could very well be a follow-on or an aftermath of the depression in corporate profits that we have talked about. I'm sure as people discuss these numbers, you're going to hear them again referred to retail sales being strong. The latest retail sales data is August, and keep this in mind, the seasonal rise in retail sales is very reminiscent in terms of its strength, its slope, to 2016 and 17. And for those of you that are following ITR closely, you may recall that's one of the cycles that we're using as a template for what to expect in 2024. So we are right on target, it seems, based on the retail sales data. It is not robust, it is not strong, it is not overtly recessionary just yet, but it's not healthy enough to keep this whole train running. And that is point number two. We'll get the September retail sales data out on the 17th of this month. So we'll have that in the next available FedWatch after October 17th. The third thing I wanted to talk about was the yield curve has narrowed to 88 points. It's still inverted, but we're down to 88 bips. And it's all because long bond has gone up so much. Closed at 4.73% yesterday. Well, actually Wednesday, closed at 4.73%. And it's on quite an interesting rising trend. A lot of it has to do with the inversion. This is the 10-year bond yield we're talking about. So because of the inversion, people are shying away from the 10-year, understandably. And it partially is the Fed cleaning their balance sheet, although they've come back a little bit into the market in the last week or so. I told you we would be thinking about this in terms of what it means for the outlook going forward. And our conclusion so far is that when the Fed does start easing interest rates in 2024, and we think they will, based on how we're reading these trends going forward, it's going to make it easier for us to get a normalized yield curve. Instead of having the Fed drop interest rates, short rates, 150 bips, they're only going to need to drop them 100 bips the way things stand today, and we'll have a normal yield curve. And that's a lot easier to achieve than 150 or even 250, which is what we were looking at before. If you follow us on the ITR Trends Report, make sure you read the executive summary. It'll be coming out in a few days, early next week. You should have it. And there's a very interesting chart from the Federal Reserve that shows that where the credit tightening has taken us to, both for tightening on large firms and the credit tightening on small firms, is enough. Historically, we're at that level where it has meant the squeeze is on for the entire business cycle. And exactly the timeline and how that plays out, you'll be able to read in the executive summary. And we also did some analysis on the consumer tightening, and that has some very real implications for 2024 as well. Why do I mention that here during FedWatch? It's just another data point, I think, that says the Fed can look at this whole dashboard of data and say, maybe we can just stand pat for right now. The most recent utterance from a Fed president is that there's about a 40% chance of higher interest rates still. We'll have to see how that plays out. But what we're looking at is the rates are high enough, the pain is high enough, and the recession in 2024 is real enough that we'll likely see some rate relief in 2024. Thanks for joining us for this edition of FedWatch. Look forward to seeing you next week.